What's up? This is Mandelo, and in this video I'm going to talk about weak highs and weak lows. Weak highs and lows are based on mechanical aspects of market structure and aren't dependent on time frames, making them distinct from poor highs and lows, which are features of TPO profiles and dependent on time and price. The term weak refers to a level price tests multiple times without breaking the level. This could be equal or nearly equal highs or lows, or it could be a series of multiple higher lows or lower highs near one another in price. Most important to determining an area to be weak is that the level has not been broken. Since weakness isn't time frame dependent, an area can be weak in low time frame, but not even located at session highs or lows. Or an area can be weakened over the course of several days, weeks, or months. The higher the time frame a level has not been broken, the more important the level can be. More tests of a level is considered to weaken it due to stop losses accumulating over time, near and beyond the level. This signals a potential area of interest since many short-term traders initiated positions near these levels, and even higher time frame traders often place stop losses around structural highs or lows. As this occurs, liquidity builds and incentive for market to move beyond these levels increases. In addition, a series of higher lows or lower highs can also build liquidity from traders trailing stops around these levels. So breaking a series of higher lows or lower highs can lead to cascading stop losses, accelerating price movement if the levels start to be broken. Despite this, the name weak can be misleading. A weak high or low holding a level may signal absorption, similar to the formation of a poor high or low, suggesting absorption in lower time frames. Probability of the level holding, at least in the short term, increases if market structure is broken in reversal direction, especially in combination with other data and levels, divergences, VWAP, order flow, or other important information. However, as long as the level hasn't been broken, it remains weak. This is common in one-sided conditions or within higher time frame trends. So don't let the bias of a level needing to be broken blind you from objectively identifying when level's holding. Because though it may be considered structurally weak, holding a weak high can be even more bearish in the near term, or a weak low can be even more bullish. This level provides clear invalidation for traders to enter new positions, and traders who position in anticipation of a break may find themselves offsides if price begins to reverse. Experience with order flow is very useful in these situations, but that's a topic for another video. Poor highs or lows refer to structure within one daily session, visible within the market profile, or TPO. Check out my channel for the video on poor highs and lows, but for a simple explanation, poor is used to describe an unfinished auction and that there is lack of excess, indicated by less than 2 unpaired vertical TPO single prints at highs or lows. At highs, this excess is known as a selling tail, and at lows, it's known as a buying tail. On candlestick charts, excess is shown by wicks at the extremes of the session. More excess indicates stronger rejections and can signal potential reversals. Lack of excess, aka poor, occurs when price tests a level at session highs or lows in more than one 30-minute interval in a daily session. So poor highs or lows can also be considered to be weak in that there are multiple tests of a level without the level being broken. TPO ledges can be another way to identify weak highs or lows not located at session highs or lows within a daily session. I also have a video on this topic. But weak doesn't mean that level is also poor. A good TPO high or low with more excess can be the beginning of a reversal, even if a higher time frame weak high or low is formed or continues to hold. A higher low might be TPO good in a daily session, but higher time frame market structure has a very close low or high which hasn't been broken, making the level weak. A TPO good high or low can be a catalyst leading to a low time frame reversal, especially when market displays a shift in structure. but ultimately probability increases for the market to return to at least test the liquidity beyond the level. If a level is broken, there are three major outcomes which commonly result. First is a swing failure pattern, or sweep, which occurs when price temporarily breaks a level and reverses to close back within that level. This is often a sharp rejection from the market failing to accept outside value and quickly returning back to value. This often can be the result of an aggressive stop hunt or liquidity grab, or as a trap for breakout traders. The next outcome which may occur is when the break of the level holds. As price begins accepting outside previous value, market seeks to establish new value and expands away from the broken level, especially with increased volume. This can be recognized as higher time frame closes beyond the broken level begin to confirm the breakout to be real. The third common outcome is a failure of the broken level to hold after some time has passed. Instead of a sharp reversal as in swing failure patterns, momentum may stall and price returns back into previous value. This can indicate market exhaustion and is characteristic of a failed auction. In all three of these examples, the weak level has been broken, and we look to other structural characteristics and information to form a new trading bias. Since weak highs and lows aren't time frame dependent, what time frame should we look to identify them? For intraday traders, use at least 30-minute or 1-hour charts to identify weak highs and lows, and to analyze market structure if a level breaks. 30-minute periods have been charted even before market profile was used, so it's widely accepted time frame for more than just TPO. For swing traders, 4-hour and daily charts are ideal for spotting these patterns and making decisions. As a side note, many are confused by the term bad. Some people will use bad, poor, and weak interchangeably, but they're not all the same. Bad is often used to describe poor highs or lows, but sometimes it's also casually used referring to a weak level. In either context, the level's not good and is a target for the market to potentially revisit. Weak highs and lows can be targets for future price movement. It's important to develop a plan when looking to trade these levels, whether it's as a potential target or as an area to watch for reversals, but should be analyzed in context of larger trends with other indicators. We should never form a bias around one aspect of a chart, so considering the broader trend and order flow can be extremely useful. Even as short-term signals appear bullish, a longer-term downtrend might be in play, and using additional tools like volume profiles, order flow, and your choice of indicators can complement your analysis. Thanks for watching. Please like and subscribe, and share if you think it's helpful. Good luck, and see you in the next one.